Good news, Canada's inflation has cooled more than economists expected it to. But does this mean that rate cuts are back on the table? There's a lot of conflicting headlines about it because even if central banks hold rates steady, fixed mortgage rates are actually falling. Let's unpack what's really going on here. Statistics Canada reports inflation eased to 1.7% in July, a bright sign. But the news may not be all that exceptional. Yahoo Finance reports that a lot of this was driven by gas prices coming down and food prices keep pushing higher. Now, the Globe and Mail put out a headline that says Canada's inflation rate slows, raising odds of a Bank of Canada rate cut. Bloomberg's headline states that inflation was driven by falling gas prices, and Reuters stated that this news is boosting some hopes for a rate cut. While others are sounding a note of caution, Canadian Mortgage Trend says the Bank of Canada is likely unmoved by this modest dip in inflation. And Better Dwelling pointed out that Canadian inflation actually accelerated, especially in shelter and food, the very cost that people are still noticing. BMO Economic recently put out a report that stated how core CPI is still higher than the Bank of Canada would want it to be to get into a cutting environment. And I think this is a very important distinction because the Bank of Canada doesn't really pay a ton of attention to CPI in their decision-making process. A lot of it is based on core CPI. Now, a lot of people, when they watch videos that I do about inflation, they often have the question, if inflation is down, why are prices still going up? And there's a very simple explanation for this. Inflation means that prices are increasing. Disinflation, which means inflation is coming down, means that prices are rising, but they're rising more slowly than they were before, like now. And deflation is when prices fall, something we're not seeing yet, except in gas prices, which is what brought inflation down. Even with a lower inflation rate, prices remain much higher than before the pandemic. Cumulatively, Canadians have seen roughly 20 to 25% inflation since the beginning of the pandemic. That's why your bills still feel expensive, even if your rate of increase in inflation has slowed. So when they say inflation is coming down, it doesn't mean that the price of stuff is falling. It just means it's going up less quickly. Now, when you look at CPI, you really want to look at the difference between headline CPI, which includes everything, gas, food, shelter. Core CPI strips out volatile items like food and energy to focus on underlying trends. And this is really what the Bank of Canada is paying the most attention to. Core inflation is still running about 2.5% to 3%, which is above the bank's 2% target, especially due to ongoing shelter cost pressures, which will come down over the next little bit. And I've mentioned this in a couple of past videos from the Bank of Canada's monetary policy report, but we know rent is falling, which means that rent inflation should be falling. And we know we're going to get past the mortgage renewal wall, which means that the mortgage shelter cost should also get reduced out of CPI as a major component. Now, here's the plot twist. Even though the Bank of Canada hasn't cut rates, fixed mortgage rates are trending lower. Why? Fixed rates are closely tied to the Government of Canada's 5-year bond yield, not directly to the Bank of Canada's policy rate. When bond yields fall, fixed mortgage rates generally follow. Typically, if bond yields are falling, they might want to charge a little bit of a higher risk premium or spread on top of the Canada 5-year. So here's the chain reaction. Lower inflation and economic uncertainty typically push bond yields down. Banks then reduced fixed mortgage rates in response, even if headline rates like Bank of Canada's overnight rate stay put. It's almost like the bond investors forecasting what they feel rates are going to be for the next 5-year period, for that duration of the bond. I also want to highlight a tweet from a friend of mine, Ron Mortgage Guy on Twitter, Angry Mortgage here on YouTube. I've been on his show a couple of times. It really sums things up perfectly. Fixed rates are dropping even though central banks haven't budged. It shows the practical side of how the bond market moves ripple directly through to fixed mortgage rate. So what's the conclusion here? Where do we stand on rate cuts? Headline inflation has dropped sharply, which is positive. It's obviously going in a good direction, but there's a lot of volatile elements in there like food and fuel. Core inflation remains sticky, especially shelter, with pressure kept on the Bank of Canada as a result. And food and fuel is really a big one. Fuel very much related to a lot of geopolitical issues, and food, we get a lot of our food from the US or settled in US dollars. And so this is very vulnerable to the tariff environment. It's not like cars or other things that people purchase less frequently. The tariffs are impact and push-throughs are felt immediately. So all in all, rate cuts probably aren't back yet. I think that most economists are still expecting the Bank of Canada to be cautious ahead of the Fed's predicted September rate cut, which is now an 85% chance of a rate cut in September from the Federal Reserve in the US. So maybe a little early to get hopeful about interest rates coming down and making mortgages more affordable, resurrecting the housing market. But we're certainly trending toward a place where that will be possible. If you found this video helpful, I'd really appreciate it if you hit the like button and subscribe for more market breakdowns. And let me know in the comment, mortgage renewal coming up right now. Would you be locking in a fixed rate, or would you be taking a variable rate to try and catch that downside potential in the Bank of Canada's further decisions? Thanks for watching. As always, I really appreciate it. Your time means a lot to me. I'll try and keep these videos coming. Hopefully I'll see you in a couple of days.